The S&P 500 is built to always go up over time. It rebalances quarterly to replace failing companies with strong ones. Thus, the monthly chart ends up looking like this. Now, I want you to really think about that contextually. There's basically nothing that exists in the stock market that's guaranteed. The largest companies in the world that people think will never fail have come and gone decade after decade. But now we're handed an index that quarterly rebalances so that it always goes up. There should be a way that we could take advantage of this for our own profit, right? Well, luckily for us, there is a quant trader and educator named Larry Connors who built a mean reversion strategy around the index, made a lot of money doing it, and gave us the blueprint. Returning subscribers watching this video will know that on this channel, we build codified trading strategies. So I'm going to show you the source code for this strategy while I go over its rules. It's very simple. It is only comprised of two studies, the relative strength index and the simple moving average. Corey Connors took advantage of the relative strength index, but lowered the length parameter down to just 2. He was performing the relative strength index calculation only over the last 2 bars. To put that in context, by default, this length parameter in the relative strength index study is set to 14. So he is using a much quicker, much more responsive relative strength index equation to determine when stocks are on a dip or on a rip. He's catching those moves much faster. Next, the current price must also be greater than the 200 length simple moving average. Once again, this is a mean reversion strategy. Remember, the S&P 500, as we talked about in the intro, is built so that it will always go up given enough time. So what Corey Connors targets here is to find when the S&P 500 is currently strong, currently in uptrend, however, currently on a dip. The sell is when that same 2-length RSI value crosses above 70. That's it. It's a very, very simple strategy, and let's jump into the results. Real quickly before we do, I just want to let you know that if you are interested in this sort of custom coding within ThinkorSwim, over on my website, daytradingstrategies.net, I have published over 150 custom coded strategies, studies, stock scanners, etc. And right now, I even have a handful of free codes that you can go check out and import, obviously at no cost. So go at least take advantage of the free codes, go read the reviews while you're over there, decide if it's something that can help accelerate your trading journey. The website will be linked in the description down below this video. Here we go. I am now running the strategy on the S&P 500 daily chart. We have hopped down into the daily time aggregation as that is what he traded the strategy on. I have turned on the floating P&L study, which is one available to you by default within ThinkorSwim. Obviously, it shows the profit and loss of the strategy running on the chart. I have also turned on my custom built backtest labels. This one will not be available to you unless you import them from my website, daytradingstrategies.net, but they show very important statistics about the strategy. Obviously, the total P&L, kind of who cares. More importantly, win percentage. The strategy has an 80% win percentage. Its average win is $340, and this is on $25,000 positions. So you can sort of scale that to whatever position size you would take. The average win is $340. The average loss is $370. So basically 1-to-1 risk reward, 80% win rate. That is really, really good. And you can tell that because what I believe to be the most important statistic when backtesting a strategy, the max drawdown percentage, meaning what is the running difference from the peak P&L to the lowest P&L that comes after that, is only 3%. The largest drawdown this strategy incurs on the S&P 500 is 3%. Now, the same argument always shows its head whenever I show a back test like this. Well, Trey, the buy and hold strategy would outperform this strategy. So obviously this strategy is a bad one. Well, I've turned on my buy and hold strategy here. If you can see that very small green arrow there, this is in February of 1993. Funnily enough, the same month I was born. That is when the SPY ETF went public, and then it just literally never sells. So the strategy just holds and holds and holds and holds and holds. It is still holding to this day, and it is up over $123,000. Yes, that is up a lot more money than the strategy that I just showed, the mean reversion strategy. But remember, in that back testing, I talked about a couple of things. One, I talked about win percentage. And also within that strategy, I didn't build it so that it scaled its positions alongside its profits, right? Like over time, like in 2020, it was already up like 25 grand or whatever. So instead of $25,000 positions, it could have been taking $50,000 positions. And you can build a strategy in ThinkorSwim to load like that, but it's a real pain in the ass, and often it doesn't load in the way it's supposed to. So I tend to not worry about it. But that's answer number one. If you scaled up your positions with the profit you were making, which is of course a big like reason for active trading, then the total P&L would be way, way, way higher on the mean reversion strategy. Point number two, what did I say on that mean reversion strategy that I thought was the most important statistic in backtesting a strategy? It was the max drawdown percentage, right? And the max drawdown of that strategy was only 3%. I want you to look at some of the drawdowns that happens in a buy and hold strategy. This is the 2022 bear market. Near the peak, you are up over $98,000. At the valley here, you are only up $70,000. The buy and hold strategy, you drop $23,000 holding through this peak through this bear market. During COVID, right here, you're up $66,000. Towards the bottom of COVID, you are only up $41,000. It's another $20,000 drawdown, like a 30% drawdown on your P&L there. Let's go back to, is this 08? Yes, here is 2008. Towards the peak, you are up over $25,000 in the strategy. Towards the valley, you are only up $6,000, $7,000 on the strategy. That is another 20% drawdown. That is like an 80, 90% max drawdown. You get the idea. I could go back to even the .com and you would see a similar sort of drawdown. You get the idea. A strategy, a much more actively traded strategy like the mean reversion one, yes, for right now, it has underperformed the buy and hold strategy. Freaking everything has underperformed the buy and hold strategy because SPY has never done anything but go straight up. What if it doesn't, right? What if it doesn't just keep going up? The active trading strategies, like a big reason why we actively trade is to protect ourselves from these kind of drawdowns in our portfolios. That is a very important point that people that argue for the buy and hold strategy always tend to miss out on. They are just collecting massive max drawdowns along the way. And it's worked, and it's worked, and it's worked, and it's worked, and maybe it'll continue working forever. Maybe it won't. Anyways, simple one today, ladies and gentlemen. Simple two-line strategy. Buy when the stock is above the 200 simple moving average and the 2-length RSI is less than 10. This looks crazy, by the way, but nothing that works is actually crazy, right? And then sell when that same RSI length of 2 gets up and over 70. This provides you a high win rate and a low max drawdown percentage on the S&P 500 index. Hit like if you learned something, subscribe to the channel if you would like to continue learning. Check out my website, daytradingstrategies.net, if you are interested in this sort of custom coding within ThinkorSwim. And if you did enjoy today's video, why not check out this one here to get some more education from me.